Most business owners know exactly what the revenue is. A lot of them even know whether they made a profit last month. But very few people regularly look at their balance sheet. And honestly, that's usually a report that tells me how much pressure a business is actually under. Think of your profit and loss statement like a weather report. It tells you whether it rained or shined over a period of time. But the balance sheet, that's the structural engineering report. It tells us what's sitting underneath the business right now, what the business owns, what it owes, and how much financial weight it realistically is carrying. One of the first things the balance sheet reveals is your cash reserves. Not just whether money came in this month, but whether the business actually has breathing room. Because cash reserves can change the way owners make decisions. You negotiate differently, you think more clearly, you're less likely to panic during a slow month. A lot of businesses don't fail because they're unprofitable. They fail because they run out of breathing room. So here's a simple test. If your sales completely slowed down tomorrow, how many weeks could your business realistically operate before panic starts setting in? Is it 1 to 2 weeks? Usually means you're under high pressure. 1 to 3 months means you have a moderate stability. And 3+ months is where stronger resilience starts to exist. And here's another important question. Can your business realistically handle the bills due over the next 30 to 60 days without depending on future sales to rescue it? Because that's what real stability looks like. Then there's debt. And let's be clear, debt itself is not automatically bad. Some debt creates growth. Healthy debt usually buys something that increases your capacity, efficiency, or future revenue. Maybe that's equipment that cuts labor hours in half, a vehicle that lets you service more clients, or hiring help that frees you to focus on higher value work. That kind of debt creates momentum. But unhealthy debt often keeps the business looking functional while the foundation quietly weakens underneath. Covering recurring losses, floating payroll every month, paying old debt with new debt, financing operating expenses that never create future return. Because there's a massive difference between borrowing money to expand and borrowing money just to survive another month. Debt should create movement, not dependency. And access to credit can temporarily hide the fact that a business model is no longer producing enough cash on its own. That's why you have to look closely at things like credit cards and lines of credit. A lot of businesses slowly normalize operating on borrowed money, using credit cards to cover payroll, using lines of credit for regular expenses, taking advances just to smooth out cash shortages. Sometimes that's temporary. Sometimes it's seasonal, and sometimes it happens during growth. But if the borrowing becomes permanent, the business may no longer be sustaining itself operationally. It's financing survival. So ask yourself this. If you removed your business credit cards for 60 days, would your operation still function normally? If the answer is no, there's a good chance the business has become operationally dependent on borrowed money. Now, if you're a newer business owner, this is important. Early stage businesses often carry more pressure by necessity. You may have lower reserves, higher debt, irregular income, or periods where you're personally helping fund the business while it gets established. That doesn't automatically mean the business is unhealthy. In the beginning, a lot of businesses are fragile before they become stable. The important question is the business becoming stronger over time? Are your margins improving? Is dependency decreasing? Are cash reserves slowly growing? Is the business relying less on emergency borrowing than it was 6 months ago? Because healthy businesses are not built overnight. Usually they become stable gradually. The goal isn't perfection immediately. The goal is reducing pressure little by little as the business matures. And that often happens in 2 ways. Sometimes stability improves through major growth, but sometimes it improves through smaller decisions repeated consistently, tightening your invoicing, reducing your unnecessary expenses, improving pricing, shortening payment delays, or building even a small reserve. Sometimes the strongest financial move isn't growing faster. It's creating a little more margin and a little less pressure. The balance sheet also reveals something a lot of owners miss. Just because revenue exists on paper doesn't mean the cash is actually available. You can have strong sales and still feel financially stressed because too much money is trapped in unpaid invoices. That's why accounts receivable matters. Revenue doesn't help much if the money is still sitting in someone else's inbox waiting for approval. So do an accounts receivable reality check. How much of your profit is actually just a stack of unpaid invoices? Because there's nothing more painful than paying taxes on money you haven't even collected yet. And this ties directly into one of the biggest misconceptions in business, that growth automatically means health. Sometimes businesses grow and become more fragile at the exact same time. Your revenue increases, but your debt climbs faster. Your overhead expands, your margin tightens, cash reserves shrink. Suddenly, the business looks successful from the outside while becoming harder and harder to sustain internally. Because not all growth creates stability. Some growth just creates bigger problems at a larger scale. And concentration risks matters too. If your largest client disappeared tomorrow, would the business wobble or collapse? That one question can reveal how fragile the business really is underneath the revenue numbers. So here's another stress test. If your revenue dropped 20% next month, what expense would immediately scare you? Because that question instantly exposes oversized overhead, payroll pressures, or dependency on expenses that quietly become permanent. And sometimes the fastest way to reduce pressure isn't increasing revenue. It's removing one recurring expense that no longer creates enough value to justify the stress it adds. A healthier business usually becomes less reactive over time. You have less scrambling, less rescuing, less borrowing, less panic selling, less last-minute decision-making, and more planning, more reserves, more stability, more intentionality. That's what mature businesses feel like. Finally, the balance sheet can expose stress patterns from the owner themselves. Sometimes you'll see constant owner contributions, personal money being injected into the business, or inconsistent owner pay because cash flow is too unpredictable. The business looks stable on paper, but really the owner is absorbing the instability personally. They're delaying their own pay, using personal credit cards, or severely underpaying themselves just to keep the business alive. If your business requires you to work 60 hours a week for 20 hours of pay just to keep the bank accounts positive, you are personally financing your company's survival. So ask yourself this: if you stopped personally covering the gaps and paid yourself your actual market value today, would this business still sustain itself? Because a balance sheet can expose problems months before the emotions finally admit them. It can reveal obligations quietly building in the background, like unpaid payroll taxes or sales tax liabilities that grow while you're distracted trying to keep everything moving. Some businesses feel profitable right up until the tax deadline arrives. At the end of the day, the balance sheet is not just an accounting report. It's a pressure report. It tells you how much flexibility your business has, how much stress it's carrying, and how resilient it really is when things get difficult. Because profitability matters, but stability matters too. And in the next video, we're going to talk about the report that confuses business owners more than most anything else: your cash flow. Because you can technically be profitable and still consistently feel broke if the timing of the money is off. I'll see you there.